Hi, welcome to the SP8 class. SP8 is one of the two papers in the SP series on core general insurance. While we have another SP paper for health, health is usually not included in the GI track by the IFOA and IAI, and health generally has a separate track. There's also a separate track called SP9, which is enterprise risk management for which falls under GI and everything, but it generally it's considered a separate track and thus does not fall under traditional GI definitions. SP8 is usually taken by students who are done with CS, CM, CB and sometimes the CP series papers. It is usually recommended that you finish at least the CS, CM and CB series before you move on to the SP series, because these papers provide you with an introduction on the basics which are required for you to master in the SP level papers. Before we jump into SP8, let's first take a look at how an SP paper is different from a CP, CB, CS and CM paper. And most of the differentiation comes from four broad things, which is specialization, complexity, subjectivity and marking. SP papers often have an emphasis on specialization that C papers do not have. C papers are either generic in nature or offer an introduction to the subject, and SP papers are not like that. Each SP paper goes into a deep dive of the topic that is based on. Exam questions will also reflect this. The institutes expect students to have a sturdy and in-depth understanding of the topic in question. SP papers are generally more challenging than the other papers due to this specialized nature of questions. Due to the specialization of these papers, the SP papers are also somewhat complex when compared to an average C-level paper. For example, a C-level course will not require a lot of depth when students are answering them. However, an SP level paper requires depth of knowledge in the subject and depth of understanding and nuance when you're answering a question. It is very important to have a deep understanding of the subject and answer with that depth rather than breadth. SP papers helps to focus students on their ability to answer in this depth, and this depth is what makes actuaries at the end of the day. SP papers also have a greater amount of subjectivity in the questions that are being asked, and this results in a lot more thought required to answer questions, which makes them harder because you have only 3 hours 20 minutes to write the paper, and you are not only expected to throw information that you have learned, but you are also expected to structure the information in a manner that is easy for the reader or the examiner to understand. Exam questions are therefore more difficult and hence require greater planning, which makes these papers harder. What makes these papers harder, apart from the subjectivity and the difficulty required in writing the papers, is also the marking. The marking of the exams is also slightly different. So if you are a CP, CB, CS and CM level paper, generally the marking structure is more lenient and there's more onus towards the student. However, when it comes to SP papers, the marking structure is no longer lenient, and the examiners require you to demonstrate your knowledge in the paper. So your answers should have breadth where required and depth where required. And we will discuss more about this when we handle exam technique. So now we know how an SP is different from a CP paper or a CM paper. Let's understand what subject SP8 is all about. This is taken from the CMP of ACTED, which is very straightforward. SP8 is all about understanding the main principles and techniques of general insurance pricing, applying these principles in simple situations, and analyzing hypothetical scenarios, and helping use or build your actuarial judgment to assess the implications of possible actions and develop appropriate proposals or recommendations relating to the pricing in general insurance. So the entire paper tests your knowledge as an actuary working in the pricing team of a general insurer, right? SP8, as I had mentioned before, is a specialist level paper, and it provides students with an introduction to various pricing frameworks that are used in general insurance and reinsurance. During the course, we will go through frameworks that are simplistic in nature. For example, a simple burning cost model, to frameworks which are complex and compute intensive, which, for example, GLMs. We will look at scenarios where we have to apply actuarial judgment and calculate either frequency and severity or burning cost of an insurance program and see how our assumptions affect the prices. We will also see how other factors play a role in determining price once we arrive at a burning cost. For example, once you arrive at a risk premium, what are the factors you should consider when you're converting the risk premium to an office premium? Ideally, once you finish an SP8 paper, you should be able to perform the role of an analyst in any general insurance or reinsurance pricing team. SP8 also focuses on data requirements for pricing and understanding how to attach credibility to pricing models. We will also focus on both direct and reinsurance products and analyze components of the products. But one thing you have to understand here is that when it comes to reinsurance pricing, the paper is mostly theoretical, and the questions around reinsurance pricing are also expected to be theoretical. Let's take a moment to look at the pass rates for SP8 with the IFOA. Fortunately or unfortunately, SP8 is generally considered one of the easier papers to master from a understanding and topic wise things. However, it's one of the hardest papers to pass. And you can see that the pass rates and the pass marks are reflective of the statement. So if you see the pass rates have been steadily decreasing over a 3 or 4 year period. So you can see an oscillating graph here. The pass mark has also been crashing over the past 3 to 4 diets. So this kind of indicates that the papers are getting harder and hence they are lowering the pass mark. So as the papers get more challenging, they lower the pass mark to ensure that a healthy mix of students pass. Pass rates are also very, very low compared to other SP papers. SP8 generally has one of the lowest pass rates. I'm not saying this to put fear in your hearts. I'm just saying that that is the status of things and that it's a challenging paper, which means that your preparation should be equally challenging, and you have to be at your best on exam day for you to be able to perform to the levels that the IFOA wants you to perform to. The weightage of topics for the SP8 paper. So if you look at weightage for the topics, general insurance products accounts for 20% of the paper. In GI products, we will cover everything related to the general insurance product life cycle. This is very similar to the SP7 portions, and we will keep them in place where required. About 30% of the paper, according to the institute, is data, risks and risk management. However, in my opinion, SP8 does not carry a 30% weightage on data, risks and risk management. Risk management as a topic comes up more in SP7 and SA3 than in SP8. We'll be touching upon these topics, but note that the actual exam weightage is not 30%. And my definition of exam weightage is dependent on the number of marks that have been allocated to these topics than the actual number, the actual amount of number of pages that are there in the topic. About 35% goes in rating methodology and basis, and in my opinion, this is the biggest chunk. I disagree with the IFOA that this is only 35% of the portion, and the majority of the exam portions are on rating methodology and the basis used to present rates. In rating methodology, we will go through simple frequency and severity approaches, simple burning cost approaches, credibility weighted approaches, exposure curves, GLMs, and simple collective risk models. So we will go through all the factors that will impact these rating structures. We will also look at additional considerations that are taken into account when we are building rating structures. A simple example would be, how do you account for commissions once you reach the risk premiums? One of the exercises that we will keep doing continuously is to build a rating equation that will help us understand how different components react with each other during the rating exercise. Right? About 15%, which is the final set, goes for credibility, reinsurance, and CAT modeling. In credibility, we go through standard credibility models that are applied on frequency, severity, and collective claims cost. We will also look at complements of credibility and the various different types of credibility models that are currently available. In RI pricing, we will go through all the pricing techniques that are available for different RI products. For example, your aggregate Excel, your risk Excel, your stop loss and things like that. This chapter, like I mentioned before, is very theoretical in nature and heavily text oriented. CAT modeling is an extremely important chapter not only for SP8 but also SA3. CAT modeling often, as we speak, as we look, as we go through, is becoming an increasingly major area of focus for GI. And this is primarily due to the impact of climate change and climate related catastrophes that have on insurers and reinsurers and their balance sheets. CAT models are usually heavily tested in both SP8 and SA3, and we'll be spending a fair amount of time on this before we move forward. Know a topic-wise breakdown of what SP8 is about. Let's also look at how the exam is split. So around 25% of the paper goes towards knowledge-based questions. Now, you might ask me what knowledge-based questions are. Knowledge-based questions are questions that test the knowledge in a particular area of a subject and mostly depend on the ability of the student to either recall material directly from the text or to describe content that is directly in the text. Around 50% of the paper, which is half the paper, goes towards application-based questions. These are questions that test the application of concepts mentioned in the text directly onto scenarios that have been provided. Around 25% of the paper, which is the remaining paper, go towards higher order skills. Higher order skills are questions that test the higher order skills of students. That is, students' ability to apply, synthesize, and evaluate actuarial knowledge in real world scenarios. Higher order skills often go beyond basic knowledge and require students to have a deeper understanding of the concept, and students should often demonstrate a much more nuanced approach to the answer. Higher order skills are often the hardest questions in the paper, but provide the best avenue to students to get the most marks if they can have good exam technique. We'll go through how you can develop good exam technique and how you can identify higher order skills just by looking at the question during our course. Before we move forward to the structure of the content, let me give you an overview of how the course is going to be structured. We'll be providing you with a topic that is going to be covered in a particular day beforehand, and I would highly recommend that you do a pre-read of the topic before the class begins. This will give you some familiarity as we go through the topics and will make your participation more engaging and will help you retaining more of the content. I believe in collaborative active learning, and this course will be extremely collaborative as I'll have students solve questions either individually or as a group. Moreover, videos will have to be on for everybody, and this is a mandatory requirement. I don't want to see a photo when I take a class. I want to see everybody when I take a class. I'll also have small quizzes during the class to elevate understanding of the subject matter. We will focus on exam technique wherever required to get a better understanding and get better at writing exam responses during these collaborative sessions. The video will also be available online and after class as well for you to be able to go through. SP8 is broadly split into the following large buckets, which is general insurance and business environment, reinsurance products, pricing methods, credibility, reinsurance pricing, and CAT models. I've reproduced the table of contents for the SP8 paper for your ready reference in this slide. SP8 only has 21 chapters split into 6 different parts. And this is unlike any other SP paper. For example, SP7 has 26. However, it should be noted that some chapters are extremely heavy, notably GLM and the use of multivariate models in pricing, which is chapters 16 and 17. So you have more heavy chapters, but a fewer number of chapters that's there. And that is the challenge with SP8. And we'll go through these in order of importance that we perceive. And we will take the most important topic first and the least important topic as we go and finish it out. So a little bit about myself. I have about 12 years of experience in general insurance and data analytics. I currently work as the Chief Strategy Officer for an insurtech company based out of Mumbai. I have an AIA with the IFOA, and I topped in the SP7 paper in September 2021 and the SP8 paper in April 2021. I have been I've been a supporter of Arsenal since 2002. So if anybody has any questions or if you want to have any debates on Arsenal performing in the PL, you can please reach out to me after the class. One of the most important aspects when it comes to insurance is for the underlying risk to have insurable interest. Insurable interest is a very, very important aspect that one needs to check, and this is oftentimes a very examined portion in both IFOA and IAA exams. So you might ask me what insurable interest means. So an insurable interest is one where the policyholder must have an interest in the risk. This is unlike, say, a credit default swap, for example, where you could purchase a credit default swap on another third party where you had no interest in it. And that kind of led to the collapse of Lehman Brothers and the entire financial crisis back in 2008, that they did not have insurable interest. So most insurance regulators in the world mandate that for something to be insurable, they needs to have an insurable interest. And there are some criteria, and this criteria is often checked not only in IFO and IAI exams, but also in real life. So this is something that you need to be aware of when you are an actuary and you are involved in running an insurance program for your company or your insurtech. So the first I mentioned, right, which is policyholders must have an interest in the risk. The second is that the risk must be financial and quantifiable in nature. So the risk cannot be something which you cannot quantify. In that case, there is no insurable interest there. The amount payable must have some relationship with the loss. And this is a very important criteria for people to understand. You cannot have an amount, a claim amount, where with the calculation of the claim has no relation to the nature of the loss, right? And risks should be independent and pooled. And this is very important. This kind of helps the insurers, right? The whole concept of insurance is risk pooling, and if risks are not independent and they are not pooled, that kind of creates a major set of other risks for the insurers. Moral hazard should be minimized. So moral hazard should be minimized for the insurer, because if there's moral hazard, then there's a very high likelihood. In fact, there's close to 100% chance of a claim being coming. The probability of event occurring must be low, which basically means that the frequency of claims must be low. The overall limit of liability for the insurance should be limited, which means that insurers should not have unlimited liability. However, this is generally a rule that is followed with exceptions, and the exception being third-party insurance liability. So for those who don't know, in India, TP liability that is there existing for the motor vehicles, that's an unlimited liability policy, right? And that's there because the laws have mandated it. But if the insurer has no volition to legally provide it, most often than not, insurers will not provide unlimited liability policies. There should also be sufficient historical data to provide the insurer with information to price the policy. So this is also another important aspect. If there's no data, it's not that insurers can never price it, but preferably insurers should have sufficient historical data. Let's also go and talk about Ubma fides, which is Latin for utmost good faith. This is something that is often ignored. Most of them don't know it, but it's better that we spend at least a minute talking about it, because this kind of gives us an idea about how insurance is run, how the business is run, right? And this is the principle behind all insurance policies. And what does utmost good faith mean? Utmost good faith means that there can be no misrepresentation in an insurance policy when it's being purchased. And if there is even material information that the customer knows, they have to provide it to the insurer. This is unlike any other business in the world where such level of faith, the utmost good faith component, is not required. So let's come to subrogation. Subrogation is nothing but the substitution of one party as creditor with a transfer of rights and responsibilities. So this happens within insurance when a claim is accepted by an insurer. The insurer basically assumes the responsibilities for the claim, but also gets the rights to recover losses. Subrogation is the principle that allows insurers to replace policyholders in the law, and the insurers acquire all rights and responsibilities towards the claim. Most basic, best example would be in a TP policy, right? if there is a company, let's assume there's a company which has taken a general liability policy. A general liability policy is a policy that indemnifies a company against third party bodily injury, third party death, third party property damage, any legal liability that comes out of these things. So when such a event happens and there is a case against the company for compensation, the company will show that they have an insurance policy, and the insurer will assume the place of the company, and they will run the trial, and they will pay the compensation that the court requires on behalf of the claimant, or on behalf of the defendant, which is in this case would be the company. What do we mean by a discovery period? A discovery period is basically a time limit that is placed by an insurer within which a claim must be reported. It's a very simple point. If I have a discovery period of 15 days, it basically means that if there is a claim event that happens in which the policy can trigger, I have to notify the insurer within 15 days of the claim happening. It generally applies to classes where there is an inordinate delay between occurrence and awareness of claims. For example, D&O, E&O, CGL, and these kind of policies, right? Where the claim event could have happened in say 1980, and then you would not know that a claim had occurred until say 2000, right? Because of latent claim issues. Now, why is that done? It's done simply to limit an insurer's IBNR. If I have a discovery period, my IBNR is automatically limited. And when my IBNR becomes limited, it reduces the premium to the end customer. A pro tip for exam preparation would be to think of additional knock-off effects both insurers and customers can face because of having a discovery period, and let me know. Another term that's generally thrown about is called the hours clause. The hours clause exists mostly within CAT XL-RI policies that have, and they basically provide a time limit on when a claim can be filed following a natural catastrophe. Usually in real life, hours clause is limited to 72 hours, which means that you have to report all CAT claims within 72 hours of the CAT actually happening. Why is this done? Again, provides the insurer and reinsurers with the ability to tag claims and reduces the chance of fraud. So if I don't have an hours clause, say 4 months after a hurricane or something, somebody can put a fraud claim and try to defraud both the insurer and the reinsurer. And they have this primarily to ensure that does not happen. Sometimes it's very important to understand basic terms which will strengthen your understanding of the subject. And such basic terms often get asked for 2 to 3 marks in exams and are often very easy ways to get full marks. However, many students fail to get even 1 or 0.5 marks in such questions because they tend to skip over such basic terms. And one of those basic terms are excess, deductible, and franchising. Now, before we begin, can anyone tell me the difference between these 3 terms? You might actually be surprised to know that many people in the insurance industry themselves do not know. If you have a doubt, go and ask your teammates or go and ask your underwriting team and ask them to tell the difference after today. I will assure you that you'll find the results truly shocking. So the first thing to understand is that excess is not equal to franchisee, which is not equal to deductible. Deductible is the first X rupees of a claim that is not payable, and the limit is usually not preserved. What does this mean? This means that if a policy has a deductible, you'll never get 100% of the claim from the insurer. Excess is the first X rupees of a claim that is not payable, but the limit is preserved. So which means that when you have to pay an excess with a larger claim, you will get the limit that you paid for. Franchisee is basically a minimum percentage of the loss that an insured must suffer before the claim gets accepted. In the event of a claim being accepted, the policyholder will pay from the grounds up, which means he'll pay the entire portion without any deductible or without any franchisee component. Right now, let us take a look at an example and let us look at how these 3 components will affect the claim scenario. Right? Let's consider a simple example. And let's consider a simple scenario. Let us assume that we have company X that has taken a $2 million policy. So the limit is $2 million. And unfortunately, it suffers a loss of $1.2 million. Now, I have given out the claim payouts under the 3 scenarios, which is the leftmost is the deductible, the middle scenario is the excess, and the rightmost is the franchisee. So you can see with a deductible of 250K, the first $250,000 does not get paid out, and the claimant gets 0.95 million, which is 1.2 million minus 0.25. In the second case of the excess, the payout is the same. The excess of 250K doesn't pay out, and then it pays out 0.95 million. In the third case, since the claim amount is greater than the franchisee amount, the payout is made in full to the customer. So customer gets $1.2 million. Now you might ask me, Sunil, the payouts for excess and deductible are the same. Why are we creating such a hue and cry, and why are we differentiating between excess and deductible? Which is a very fair point. Now let me take you to the next question. Now in this scenario, the limit purchased by the company is $2 million, and the claim gets revised from 1.2 million to $2.25 million. Now in this scenario, the claim payouts will now change. In the first scenario with the deductible, the first $250,000 deductible is not payable. Then the policy limit is $2 million. So the insurer will only pay out $1.75 million because the policy limit is $2 million. So in this scenario, the customer has a $500,000 hole because the lower and upper bands are not payable under the deductible. Now in the second case, where there is an excess, the policy will not pay for the first 250K, but the cover will pay out until the limit gets exhausted. In this case, $2 million. Now the customer's liability here is only $250,000 as compared to a liability of $500,000 in the previous example. In the franchisee case, again, the case is clear cut. The liability is greater than the franchisee amount, so the claim will get triggered and $2 million will get paid out. The customer will have an ultimate liability of $250,000 that they have to pay from their pocket. So now you can see that excess and deductible are not the same, and oftentimes this gets tested in IAI papers a lot. There have been more than one question from past papers where they have asked you to differentiate between franchisee and excess and deductible, often for 3 marks or 4 marks. So it's an easy get. If you understand this, you will get 3 marks easily. Let's move on to the types of insurance policies that we will cover in subject SP8. This is also common to subject SP7, by the way, and subject SA3, because a lot of the questions are linked together. There are only 4 main types of policies that we will cover entirely throughout the course, and most of insurance can be plugged into any of these 4 things. The first is liability. These are policies where essentially any legal liability is indemnified. So these are basically cases where the insured customer is required to legally pay compensation to a third party. Perfect example is going to be TP liability, CGL, employer's liability, things like that, right? Property damage are policies that cover any loss or damage to an insured customer's own property, not any third party property. In this perfect example is motor. Financial loss are policies that indemnify insured customers against any financial losses in certain cases. So a perfect example would be business interruption, which compensates a policyholder for any financial loss of not being able to operate a business due to covered losses. Very important pro question for students here is, what is BI called in India? Do you know what business interruption is called in India? If you know, put your answer in the comments. Fixed benefits are policies that pay out a fixed sum of money if an event gets triggered. Personal accident is a perfect example of fixed benefit policies. When we talk about policy characteristics, now that we have talked about types of policies, let us also talk about policy characteristics. And most of GI questions in SP7, SP8 and SA3 are around these policy characteristics, right? We talk about the following 5 details. And for mastering the subject SP7, SP8 and SA3, students will have to have a thorough mastery on these 5 areas for every policy that is there. It might be difficult initially, but it will become easy once you have a little bit of practice. And that is what we will aim for in future classes as well, to get you to practice these types on different policy types. To that end, let us first look at what we are going to cover, right? We are looking at what are insured perils, what are benefits, what does basis of cover mean, what does measure of exposure mean, what does claims characteristics mean, and what are risk and rating factors. Let's start with benefits. Now, benefits is basically the component of a policy that provides something to the customer once an insured peril is triggered. So for a motor policy, for example, the benefit is the amount that the benefit here is the insurer repairing and replacing the vehicle. In a liability policy, it could be the money that the insurer provides due to any legal liability on behalf of the customer. Benefits will have to be clearly described by students when you get this kind of question. What is an insured peril? An insured peril is something that will cause a loss and trigger a payout from the insurance policy. What is this peril? A peril can be either natural or man-made. So a flood is a type of peril. A cyber attack is a type of peril. Basically, an event that causes a claim is called a peril. So in motor insurance, perils could be hurricanes, explosions. So you would probably, if anyone has worked in insurance, you'll know perils such as STFI, Flexa. So STFI basically means storm, tempest, flood and inundation. Flexa means fire, lightning, explosion and aircraft damage. RSMD means riot, strikes and malicious damage. So these are generally covered under motor policies, property policies. So this is standard in India. Remember that perils are events, not monetary awards. And the examiners expect you to apply some common sense when writing these perils. We then move to basis of covers. What is basis of cover? So when we talk about the characteristics of an insurance cover, we also have to talk about the basis of cover that gets provided, right? Now there are two main types of cover that can be provided. One is called a losses occurrence basis, which is also called the claims occurrence basis, and the other is a claims made basis, right? Now, losses occurring policies are policies which cover losses that are defined in a predefined period, no matter when they're written. So to give you an example, if I underwrite a losses occurring policy on 1st January 2024 to 31st December 2024, I will be covering all claims that occur in 2024 calendar year, regardless of when they're reported. So that claim could get reported in 2026, could get reported in 2028 for all we care, it could get reported in 2030, but as long as it occurs in 2024, the insurer will have to pay them. When are these policies preferred? These policies are preferred when the claim date is definitive. That is, it is easy to establish the place and time of claims. This is also preferred when there is not a lot of delay between the average claim occurrence and the claim event being not noticed by the insured customer. So for example, OD car policies. These are mostly written on a losses occurring basis because it's the moment there is a damage to your car, you'll know that such a damage has happened and you'll be able to call the insurer and tell them that the damage has happened. This is not written in lines such as liability, where let's say that you're writing a product liability policy. It might be difficult for people to know that they've had asbestosis when the policy is in force, and let's say 20-30 years later that asbestosis develops into cancer. In this scenario, it's impossible for an insurer to determine that the exposure happened during the policy period, and hence most often than not liability policies are written on a claims made basis, right? Claims made policies are policies where the losses that are reported in a defined period are covered no matter when they have occurred. So if I underwrite a claims made policy on 1st January 2024 to 31st December 2024, I will be covering all claims that are reported in a year regardless of when they occurred in the past. So if a claim occurred even in 1980 and I've written a policy in 2024, I have to cover. It will trigger. However, you might ask me a question. How do insurers limit their liability in such cases? You may say, Sunil, I'm the actuary. I've got a customer who is asking for a claims made policy in 2024. I don't know what they have historically written. So what do you think insurers do? Insurers add a clause. And does anybody know what that clause is? That clause is called retroactive date. What is retroactive date? Retroactive dates are dates before which any claim occurring is not accepted by the insurer. So in your hypothetical example, you might say, okay, pay me 5 lakh rupees as premium. I will put a retroactive date of 1st January 2024, which means that any claim occurring before 1st January 2024 is not my concern. It's somebody else's concern, right? This is heavily present in almost all liability policies and is a way for the insurer to limit their claims. Let's move on to exposure measures. An exposure measure is a quantity that allows the insurer to measure how much risk they have accepted in return for getting premiums. So you have to remember that one important point here is that the amount of risk underlying an individual policy is never known. Nobody can know it because it is such a complex topic. However, a good measure of exposure should generally have two criteria. The first criteria is that it should be a good measure of the amount of risk. I know it looks like a tautology, but just play with me over here. It basically means that the total amount of expected claims should generally be a proportion of the exposure, right? And the second measure is that it should be practical, which means it should be objectively easy to measure and derive. Practicality as a point is often broached a lot in the SP level subjects, and there is a reason for it. It is usually very easy to derive a number from data. It's not very difficult to do this at all, right? You can create a simple model and you can get whatever output you want, right? Because most models have this innate law in them, which is GIGO, garbage in, garbage out. So it's very easy for anyone to just create some model and just throw out some random number. What's more difficult is to get a practical figure that will be easy for people to understand and apply. And this is where most of your work as actuaries is going to be. If you are in the pricing team, or if you're in the reserving team for that matter, or any actuarial team for that matter, most of your work will be around how do I apply my actuarial judgment? Here is a model. I have to apply my actuarial judgment and I have to arrive at a number which is practical and backed by the data. The last topic is claims characteristics, right? This is perhaps the most important topic when we are talking about a product type. It is often important to describe the claims characteristics of a product type when you're asked a question in the exam as to describe the characteristics of this particular policy. You'll have to talk about a number of things, and it is often helpful to talk about a number of things. And I'll tell you why once I'm done explaining this as well, right? So what you have to talk about when you're talking about claims characteristics is you have to talk about event delays that can happen. You have to talk about reporting delays that are there in the product. You have to talk about settlement delays in the product. You have to talk about frequency and severity characteristics. You have to talk about nil claims and reopen claims characteristics. You have to talk about latent claims, large claims, and aggregations. So I'll give you a simple example. Let's take motor OD as a perfect example, right? So let's run this thought exercise. What are the event delays in motor OD? Not very significant. What are the reporting delays? Not very significant. Short reporting delays, right? Which makes it a very short tail line of business. What are the settlement delays? There's not a lot of settlement delay, right? Once the claim is filed, once the surveyor makes a judgment on whether the claim is genuine, and once he gives a surveyor report, the insurer will review it, they'll make the claim payments. So settlement, the time between reporting and settlement is not very hard. What are the frequency characteristics? Motor OD has very high frequencies. Oftentimes, it is not uncommon to see frequencies of above 30% for motor lines. What is the severity? Severity characteristics of motor is that most claims are low in nature, very small claims. There may be some which are very large claims, right? What about nil claims? There are quite a few nil claims in motor claims, right? You might sometimes have incorrect NCB declarations. You might sometimes have very, very small claims which are below the deductible amount. So there are quite a few claims. Maybe not in India, but there are such cases do happen a lot in the UK and the US because the deductibles are generally higher. What about reopen claims? Very rarely some motor claims are reopened, but most rarely most OD claims are not reopened, right? What about latent claims? Very negligible in motor OD claims. What about large claims? There'll be some large claims, but not a lot. probably about 3% of your total portfolio will be large claims. What about aggregations? Very high chance of aggregations with motor OD, right? So it might be due to some kind of a pileup happening. There's a very high chance of motor aggregations. Now with this information, why are we doing this exercise? We're doing this exercise because you should understand how you have to answer the question when you're asked this question in the exam. This is how you have to think through, and this is the answer that you have to provide when someone asks you in the exam, what are the characteristics of these claims? Now, how can you use this? You have to derive insights from these, and you have to explain contextually how these insights affect the case that you're working on. Let's quickly touch upon risk and rating factors. We'll go a lot in depth on risk and rating factors over the course, but I'm just going to give you a small introduction, right? Why do risk and rating factors exist? Risk and rating factors exist because exposure measures are not the perfect measures of the amount of risk that is accepted. So when you don't have a perfect measure, you add further measures which will try to explain the imperfections in the exposure measure. So risk factors are basically additional factors that influence the amount of risk that is being underwritten, as simple as that. Rating factors are nothing but risk factors that show up in the pricing calculation. So for India's example, I'll take motor example, right? Vehicle CC is both a risk and a rating factor, right? Because vehicle CC is a rating factor that shows up in your pricing calculations. You have to remember that all rating factors are risk factors, but not all risk factors are rating factors. And this is very crucial to understand that.